Yes, hello everybody. This is the lecture video for Chapter 11. This is Part 1. In Chapter 11, we're working our way around the balance sheet, and the last few chapters we talked about the asset side of the balance sheet. Now we're moving over to the liability side. The first area that we come to would be current liabilities. Current liabilities would be liabilities that generally are paid off or satisfied within 1 year. So we're talking about things such as accounts payable, notes payable, employee payables such as salaries payable, and we'll talk about some other payroll type liabilities, taxes payable, income taxes payable, things like that. So again, current liabilities, obligations that are due within the upcoming year. So we're going to talk about a couple areas. The first would be notes payable. Then we're going to talk about the current portion of long-term debt, just briefly. We're going to talk about some payroll, tax liabilities. And then we're going to talk finally about what's called contingent liabilities. So the first section is notes payable. Notes payable are somewhat similar to accounts payable. Accounts payable, of course, are usually arise from purchases of inventory or supplies, say, on account from suppliers or vendors. Usually are very short-term in nature, 30 to 60 days. Typically do not involve the payment of any interest. So those are trade payables, they're typically called. Notes payable are a little different. Notes payable are typically written notes, so it's a more formal written arrangement. They're typically a little bit longer term, so they're going to run usually more than 30 days, but again, less than a year. And they typically involve the payment of interest. So the purpose of notes payable and the way that they usually arise is the purchase of an asset. So for instance, a lot of you have maybe had some experience where purchasing an automobile, an auto loan would be an example of a note payable, although that would typically run more than a year. But that is a type of a note where you are agreeing to repay a loan in writing. It has a lot of other terms, but it also has a specific interest amount that's due. It specifies the payments and has some other provisions in it, but it is in written form, more formalized agreement. So it could arise from the purchase of an asset. It could arise just from borrowing money. So we could borrow money from a bank or from a, say from the bond market. We could borrow money in the public markets as long as it's less than a year. Or sometimes when we're falling past due on an accounts payable, the supplier will either take drastic measures such as cut us off and not supply us anymore, or will agree to continue to supply us, but will convert that accounts payable into a notes payable for maybe a longer term, allowing us more time to pay it off, but now it would begin to accrue interest, and interest would be payable on that obligation. So let's talk about interest, because that is one of the concepts of the note payable. The rest of it, I think, is pretty straightforward. But whenever we talk about an interest rate, and this is for anything, we talk about the interest rate on a credit card or a mortgage, any type of investment, what we're talking about is the annual rate. So it might even be, let's say, a 6-month CD. If the 6-month CD is paying a 2% rate, that's a 2% annual rate. So that would be on an annualized basis, you'd be earning 2%. If it was a 6-month CD, in effect, you're earning 1% on your money. But the rate that they're quoting is always based on a 12-month annualized rate. Okay, so that's very important. So credit card rate, you're paying a 24% annual rate. So that works out to be about 2% per month. But the rate that they're quoting you is based on an annualized basis, okay? And in terms of the annualized basis, it works out to be, from a financial point of view, financial calculations are all based on a 360-day year. And that's because most investments are usually set forth in multiples of 30 days to keep it simple. So obviously every month has a different number of days. So instead of saying this is a February note or a March note, they have different number of days. What they're going to do is say this is a 30-day note, 60-day note, 90-day note, 120-day note, etc. To keep it simple. So usually we're talking about increments of 1/12 of a year. But it's the number of days divided by 360. So for instance, if we had a 90-day, $10,000 6% note, the way we would calculate interest would be the $10,000 face amount of the note times the 6% annual rate, and then we would prorate that for the amount of time the note is going to be outstanding. The note is outstanding for 90 out of 360 days, which is basically 1/4 of the year. So it's 1/4 of the $600 of annual interest. 1/4 of that is $150 of interest that you would earn on that or pay on that, depending upon whether you were the investor or the lender. Okay, so that's how we're going to calculate the amount of interest. All right, so when we talk about notes payable, we basically have two types of notes payable. We have, number one, we have interest-bearing notes, and then the second, which I will list in a moment, and we'll call those discounted notes. Okay, so interest-bearing notes, we're going to go walk through the entries. Interest-bearing notes, we pay the interest at maturity. So interest is paid at the maturity date. Maturity being the date that the note is due. So this is a 90-day note. So what would the entries be if we were, and again, this is a note payable, so we're the ones, let's say we're just issuing this for cash, we're just borrowing money. So on the date of issuance, we're debiting cash for the full amount, so we're basically borrowing $100,000, and we're crediting notes payable, for $100,000. So we receive $100,000, we owe $100,000. At the maturity date, when the note comes due, of course we're going to credit notes payable because we're going to pay it off. We're going to credit cash, but we're also going to have to pay the interest. So let's leave the cash for the moment. We're going to owe not only the $100,000, but we're also going to owe the interest. So what we're going to do is we're going to debit interest expense for the amount of the interest. And again, we're going to calculate that like we did up above. So it's $100,000 times 5%, and again that's the annual amount, but it was only outstanding for 90 days. So 90 divided by 360, so that's just a quarter of the amount of the total interest for the year. Total amount of the interest for the year would have been $5,000. A quarter of that is $1,250. And so our total amount of cash that we're going to have to pay off both the principal or the note plus the amount of interest would be $101,250. So those would be the entries for both the issuance of the note when we borrowed the money and the maturity when we paid the note off. All right, I just moved the screen up a little bit. The second type of note is what's called a discounted note. A discounted note is where we pay the interest up front or at the time that we borrow the money. So let's take a look at that and see how that works. So here what we're going to do is we're going to debit cash, credit notes payable. And so here notes payable, we're still going to pay off the $100,000. But here, instead of receiving the full amount of cash, we're going to pay the interest up front. So we have interest expense on the date of the issuance. So we have interest expense of $1,250, and it would be calculated the same as the other example. So now, in order to make the entry balance, we're not going to get the full $100,000. We're only going to get $98,750. So again, the note is still for $100,000. However, we're paying the interest in this case up front, so we're receiving the $100,000 less the amount of the interest. We're only receiving $98,750. At the maturity date, since we've already paid the interest, what we do is we pay off the note. So debit notes payable, $100,000, and credit cash, $100,000. So in this entry, we receive $98,750. We pay back $100,000. So obviously the difference is the $1,250 of interest expense. So that ends up going to the lender. And then all the other entries, of course, wash out. So the question here is, and I'm just going to go ahead and switch the colors of the pens. So the question here is, so is there any difference? What's the difference in these two methods? Is any method better? Let's look at it from the lender's point of view. Is there a difference, or is one of these more beneficial to the lender? Now let's take a look at this. Let's take a look at what the real or effective rate is for the borrower. Okay, so in this particular case, in an interest-bearing note, we had the use of $100,000 of cash, and we ended up paying $1,250 of interest expense. And again, remember that was just for 1/4 of the year. So if we multiplied that by 4 to give us an annual rate, that would be $5,000 divided by 100,000. And so that would be a 5% interest rate, or real effective interest rate for that borrowing. We've got the full use of $100,000. We paid a 5% interest rate on that. Our effective rate was 5%. Let's look at the other one. Let's look at the discount note. Here, we only received the use of $98,750. But we still paid $1,250 of interest. And again, that was for 1/4 of the year. So if we multiply it by 4 to get an annual amount, so we would have paid on an annualized basis $5,000, but we only borrowed $98,750. So if we divide those two, we actually get 5.1%. So from a lender's point of view, this would be better. From a borrower's point of, this would be much better.